Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Unity software.
If you find our talks useful, please consider subscribe, like, and comment underneath. So let's unpack this. We are looking at a company today that has experienced what you can really only describe as a completely brutal year on the charts.
Absolutely brutal.
Right. If you look at Unity software right now, you are seeing a stock that has suffered a 60% year-to-date decline. And for a lot of investors, a chart that looks like that is just an immediate pass.
It's terrifying to touch.
It is. It's too scary. But we are bringing this to you today because when you actually look under the hood, something massive is shifting right below the surface. The headline numbers might be screaming one thing, but the underlying mechanics of the business, they're telling a completely different story.
And that is exactly our mission for today's analysis. Our goal here is to really unpack what we see as a highly compelling turnaround narrative. We want to evaluate if this situation presents an asymmetric risk-to-reward setup for you, the investor.
Especially as we look ahead to a very critical earnings catalyst coming up next month.
Exactly. Because in the wealth building context, finding a company where the fundamentals are secretly improving while the market sentiment is still heavily depressed, that is where the outsized gains are often made. We just need to figure out if Unity software actually fits that profile or if it's just a value trap.
I am always super cautious with setups like this. So let's start by looking at the fundamental turnaround and what we are calling this hidden revenue pivot. Because there is a surprising fact that really stood out when reviewing the numbers.
Yeah, the Create Solutions drop.
Right. In 2024, Unity Software's Create Solutions revenue, and for those listening, this is essentially the side of the business that provides the tools developers use to actually build the games. That revenue dropped by 28.54%, down to $613.97 million.
It's a big hit.
It is a massive hit. I have to push back here. If I am just glancing at a financial summary, a nearly 30% drop in a core business segment looks, catastrophic. How is this not a total death knell for the company?
Because context is everything here. What's fascinating is that this contraction is not simply a case of losing market share or failing to sell a product because competitors are beating them. It is actually a deliberate strategic pivot by management.
Deliberate. So they wanted that revenue to drop.
They are actively moving the company away from relying on lower margin developer tools. Instead, they are focusing heavily on their high-velocity advertising and monetization platform. Think of it like a restaurant deciding to stop selling the cheap appetizers that take forever to prep in the kitchen.
Right, and instead focusing entirely on the high-margin premium entrees and drinks.
Exactly. The top-line overall revenue might dip initially because you're selling fewer total items, but the actual cash flow you take home at the end of the night, that increases significantly.
Okay, so they're essentially trading volume.
For margin, yes.
They want the highly profitable dollars, even if it means fewer total dollars coming in the door right now.
Spot on. And we can actually see this playing out in the margin story. The numbers show that their Operate Solutions segment, which is that monetization and advertising side you just mentioned, that now makes up an incredible 66.14% of their total 2024 revenue.
Wow, so it's the majority of the business now.
It has become the undeniable driving core of the business. Furthermore, if you look at their strategic portfolio revenue, which represents their future growth drivers, it actually bumped up 4% year over year to $442 million in the fourth quarter of 2024.
And didn't the subscriptions go up too?
They did. On top of all that, within that Create Solutions segment that dropped overall, the actual subscription revenue jumped by 15%.
Okay, so the headline revenue might look like it's shrinking, which explains why the algorithms and the casual observers have punished the stock so severely. But if you're listening to this, the takeaway is that the quality and the profitability of the remaining revenue are actually improving.
Much higher quality.
High-margin subscription revenue is growing. High-margin advertising revenue is taking over as the dominant income stream. They're essentially trimming the fat to build a much leaner engine.
Precisely. It is a shift from that growth at all costs mindset, which characterized a lot of tech during the pandemic, to a focus on sustainable cash-generating business lines.
Which perfectly sets up the next crucial piece of the puzzle. if they are pivoting to advertising and monetization, we need to talk about the core growth engine powering that transition, because the absolute star of the show here is the Unity Vector AI advertising platform.
Unity Vector AI is the linchpin of this entire bullish thesis. Let's break this down by the numbers to show just how dominant this platform has become internally. It now accounts for 56% of the company's Grow Solutions revenue.
That's huge.
It is, but more importantly, it has posted mid-teen sequential growth for 3 straight quarters. Sustained sequential growth like that, meaning each quarter is growing mid-teens over the previous quarter, not just year over year, that is incredibly difficult to achieve. It proves the platform is gaining real compounding traction with advertisers.
And what caught my eye is the execution side of things. We just saw a milestone where Unity Software managed to migrate its entire ad network over to Unity Vector ahead of schedule. As of right now, 100% of their iOS and Android traffic runs entirely on this new AI platform.
A massive operational win.
But I have to ask, what does that actually mean in practice? Moving to an AI platform sounds great in a press release, sure, but how does that translate to the bottom line?
Well, that is the million-dollar question. The projection is a 15% to 20% lift in installs and in-app purchases across all that mobile traffic. To understand why that matters, we have to look at the mechanics of ad tech.
Okay, break that down for us.
In mobile gaming, advertisers care about one thing: return on ad spend. Before this AI integration, ad networks relied on broader demographic targeting. Vector AI processes billions of real-time data points to find the exact specific user who isn't just likely to click an ad, but is mathematically likely to actually spend real money inside the game.
So it's about finding the actual paying players, not just casual clickers.
Exactly. If you are a mobile game developer and Unity's new AI can suddenly get you 20% more players actually installing your game and buying digital goods, you are going to pour your entire advertising budget into that network.
That sounds incredible on paper, but we've seen tech companies overpromise on AI lists before. Is there evidence this bump is actually sustainable?
The evidence is in the forward guidance provided by management and how strictly Wall Street is holding them to it. They are targeting Q2 2025 revenues between $415 million and $425 million, with an adjusted EBITDA of $70 million to $75 million.
So they are putting their money where their mouth is.
If Vector AI wasn't performing, they wouldn't be able to guide for those numbers. Forward earnings per share estimates are sitting at 65 cents for the next fiscal year. That would be an 18.1% year-over-year increase. It shows the transition from a cash-burning story to a profitable tech platform is actively underway.
Okay, so the tech is sticky and the margins are improving. But whenever a company goes through a heavy restructuring or pivots its core business model, I always wonder what stops competitors from just crushing them while they're distracted. Why doesn't a rival swoop in and steal all their customers during this transition phase?
That is a very valid concern, and the answer lies in their competitive moat, which is backed by some truly staggering market share numbers. Consider this: Unity Software commands 25.89% of the total game development market.
A quarter of the entire market.
Right, and they power 51% of all games released on the PC platform Steam. But here's the crown jewel. They dominate an incredible 71% of the top 1,000 mobile games.
71%.
71% is practically a monopoly in the mobile space.
I want to focus on that for a second because that introduces something called developer lock-in. It reminds me of the Apple ecosystem. You know, once you have the iPhone, the Mac, the iPad, and all your photos are on iCloud, the thought of switching to Android is just exhausting. You just don't do it unless you have a phenomenal reason.
That is a perfect analogy. The switching cost friction in game development is arguably even higher. Think about it practically. If you have an entire studio of developers who have spent years learning the intricacies of the Unity ecosystem, all your existing games are built on their code bases, and all your future pipelines are integrated with their tools.
You're trapped, basically. In a good way for Unity, but you are locked in.
The sheer cost, time, and friction required to abandon all of that and migrate to a competitor, like Unreal Engine, for example, is astronomical. It's like trying to rewrite a massive 1,000-page novel in a completely different language halfway through writing the book. Most studios simply won't do it.
And it's not just the software habits, it's the legal protection too.
Exactly. Furthermore, Unity Software holds 256 U.S. patents that don't expire until between 2031 and 2042. So their proprietary technology is fiercely protected by law.
That switching cost is huge. And they aren't just relying on inertia to keep developers around. Unity 6, their latest engine iteration, has already hit 6.6 million downloads. But the real kicker is that there is a 96% developer adoption rate of AI tools within their ecosystem. Almost every single developer using their platform is plugging into their AI.
And this is exactly why the moat is deepening. What's fascinating here is that Unity software isn't just offering a few novelty AI plugins. They are successfully embedding agentic AI directly into the core daily workflows of developers across mobile, PC, console, and AR and VR.
Wait, before we move on, agentic AI is a major buzzword right now. What does that actually look like for a game developer sitting at their computer? How is it different from just using a chatbot?
It is a crucial distinction. Generative AI, like a chatbot, waits for a prompt and gives you an output. Agentic AI acts as an autonomous agent. For a developer, this means instead of manually writing hundreds of lines of code to govern how lighting interacts with a new character model, the agentic AI understands the goal of the scene.
So it does it for you.
It autonomously adjusts the physics, fixes bugs in the background, and optimizes the memory usage without needing step-by-step human prompts. When your daily workflow relies on an AI that actually does the heavy lifting for you, and that AI is proprietary to a specific platform, your switching costs go from high to virtually insurmountable. They are locking in the next generation of development.
So we have improving fundamentals, a powerful new AI growth engine, and an incredibly deep moat. But are the big institutional players actually buying this narrative yet? Let's look at how the market is reacting right now, specifically the technicals, smart money, and shifting sentiment. Just days ago, on March 3, 2026, Bank of America Securities officially upgraded Unity software from underperform to neutral, and they raised their price target from $18 to $19.
This cannot be overstated. This is a major sentiment inflection point. Getting upgraded by a prominent institution like Bank of America after a 60% year-to-date decline is incredibly telling. Wall Street analysts are notoriously risk-averse when a stock is in free fall.
They usually downgrade at the bottom.
Exactly. It suggests that they are finally looking past the terrifying chart and recognizing the fundamental recovery happening underneath. They aren't just chasing momentum, because there is zero positive momentum on the chart to chase right now. They are upgrading based purely on the math and the stabilization of the business model. The institutional bear case is actively reversing.
And it isn't just the analysts adjusting their spreadsheets. We also saw some serious smart money options accumulation, noted on February 26, 2026. For you listening, when we say smart money options accumulation, we mean large, sophisticated investors, hedge funds, institutions buying up call options or selling puts in a way that positions them for a substantial move to the upside.
They are quietly placing big bets before the rest of the retail market catches on.
But why now? What is the short-term catalyst they might be front-running?
Well, adding another layer to the shifting sentiment is some recent speculation. On February 24th, we saw a sudden surge in the stock based on unconfirmed reports of a potential sale of their China business. Now, it's important to state impartially that these are unconfirmed rumors, and we are just looking at the strategic business implications of such a move.
Let's translate that into plain terms. Basically, they were looking at selling off a geographic segment that costs a lot to run, carries a lot of complex regulatory overhead, but doesn't yield high enough margins to justify the headache. Shedding that would give them a sudden war chest of cash, right?
Exactly. Exiting a geography that historically offers lower margins is a standard playbook for tech turnarounds. A successful sale could potentially unlock a one-time cash infusion of $100 million to $200 million.
That's massive.
For a company in the middle of a major platform transition, having a couple $100 million drop onto the balance sheet provides incredible operational flexibility. It de-risks the balance sheet significantly.
It definitely provides a cushion. But we have to play devil's advocate here. We need to do a thorough risk assessment versus the asymmetric reward. What could go wrong? We've seen a lot of tech sector weakness recently. Look at the ripple effect that the recent NVIDIA Q1 results had across the entire tech landscape. If the macro environment turns hostile toward AI valuations, isn't Unity going to get dragged down right along with everyone else?
That is the primary macro risk, and it is a significant one. High valuation tech stocks are historically vulnerable to sector rotation. When the hardware layer of the AI trade companies like NVIDIA guides down or shows weakness, the software layer inevitably catches a cold.
All right, the whole sector feels it.
Investors start questioning the return on investment for all this AI infrastructure. If the broader market decides that AI monetization is further out than expected, Unity's multiple will compress regardless of how well their internal turnaround is going. They are not immune to macroeconomic gravity.
And what about the internal risks? We talked heavily about the Unity Vector AI platform.
The most pressing internal threat is execution risk. We talked about that 15% to 20% projected lift from the new vector platform. It is crucial to understand that this projection is forward-looking. Yes, they have successfully migrated the network, but if the platform fails to actually deliver that increased monetization at scale over the next 2 quarters, the entire bullish narrative collapses. The turnaround hinges entirely on that AI engine performing exactly as management says it will.
So it's a show-me story. They have to prove the math works.
Precisely. However, and this is where the risk to reward becomes asymmetric, that 71% dominance in mobile gaming provides a very sturdy shock absorber. Even if the AI turnaround is slower than expected, their core customer base is so locked in that they aren't going anywhere tomorrow. That buys management time to fix any issues.
So, synthesizing all of this, the macro risks, the execution hurdles, the deep moat, and the AI transition, we've landed on a bullish score for this setup. We're giving it a 7.5 out of 10.
I think 7.5 is a very fair assessment. The fundamental inflection and the recent institutional validation are very strong, but we absolutely have to respect the execution risks on their forward guidance and the broader tech sector volatility. Now, let's map out what this actually means for your portfolio across different time horizons.
Okay, let's look at the short term first.
If you are looking at a shorter-term swing trade, your horizon is holding into the Q1 2025 earnings in late April 2026. If Unity Vector delivers on those monetization metrics and proves the turnaround is real, we could see the stock rapidly re-rate 20% to 35% higher. That would target the $24 to $26 range as analysts scramble to adjust their models upward.
But what if you are a patient investor playing the long game?
For a multi-year hold, the math gets very interesting. Let's say the speculative China sale actually closes, giving them that $200 million cash injection. And let's assume Unity Vector continues to scale and becomes a $500 million plus revenue stream. Under those conditions, the company could hit $1 billion or more in annual EBITDA.
$1 billion in EBITDA. That changes the valuation completely.
If they reach that level of profitability, the fundamentals could potentially support a $40 to $50 stock price by the 2027 to 2028 timeframe. That is the asymmetric upside.
That is a phenomenal breakdown. Let's do a quick final synthesis to wrap this up. We started with a stock down 60%, a chart that would terrify most people. But looking deeper, we found a company undergoing a profound strategic shift away from low-margin tools toward a highly profitable AI monetization engine.
Trading volume for margin.
Exactly. We've got heavy institutional accumulation happening right now. Bank of America upgrades, smart money options activity, potential cash infusions, and they are executing all of this while being protected by a near monopoly in the mobile gaming space. They have a deep, patent-protected moat, keeping them safe while they completely turn the ship around.
And I want to leave you with a final provocative thought to mull over. We mentioned that 96% of their developers are already adopting their AI tools. Consider what happens to the global gaming industry if Unity software ceases to be just a game engine. What if, through this transition and the integration of agentic AI, it quietly becomes the default AI infrastructure powering the entire next generation of interactive media? How much is an unbreakable monopoly on the future of 3D AI actually worth?
That is a fascinating question to end on and definitely something to keep an eye on as we approach that next earnings call. Thank you so much for joining the conversation today. Keep doing your research, keep looking under the surface, and continue building your wealth strategy. Catch you next time.